What if I told you that the most sophisticated, inflation-proof machine on Wall Street is currently disguised as a concrete warehouse?
Right, the one that sells the $1.50 hot dogs and those giant tubs of mayonnaise.
Exactly. I mean, you walk in, the floors are bare concrete, the lighting is totally industrial, everything is stacked on wooden pallets.
It feels incredibly rudimentary.
It really does. But behind that utilitarian aesthetic is honestly an absolute fortress of financial engineering.
It is the ultimate Trojan horse of the retail sector. I mean, they project this image of simplicity, right? Of bare bones bulk selling.
Yeah.
But the operational mechanics running beneath the surface, like the supply chain logistics, the data capture, the pricing algorithms, they are staggeringly complex. It almost defies the standard rules of retail gravity.
Welcome, everyone, to a very special Talk Tickers edition of The Deep Dive.
Yeah.
And look, we know exactly who you are listening right now.
Yep, you are the learner.
You are an investor. You're curious, and you absolutely do not have time for corporate fluff. So our mission today is pure and simple. We are taking the brand new Q3 2026 earnings call transcript for Costco Wholesale Corporation, ticker symbol CLUAST.
We are stripping out the Wall Street jargon.
Ignoring all those executive pleasantries.
Yeah.
We're keeping the spirit of the under 5-minute Talk Tickers format alive, getting straight to the actionable, opinionated insights. Though, to be honest, we have so much ground to cover. We're going to be talking for quite a while.
We really are. We're going to hit the raw data, find the macroeconomic story driving that data, and translate all that noise into plain language.
And obviously give you a definitive verdict on where this stock sits right now.
Okay, let's unpack this. Because framing Costco as just a, bulk retailer is doing you, the investor, a massive disservice.
It's a closed-loop ecosystem.
Completely. So let's start with the first pillar of the format, the headline numbers. Because the print they just delivered is just staggering. Net income came in at $2.192 billion for the quarter.
Which translates to an earnings per share, or EPS, of 4.93 per diluted share.
I actually want to pause on that specific phrase for a second. Diluted share.
Go for it.
Because it's crucial for anyone trying to truly understand a company's profitability. So companies often issue stock options or restricted stock units to their employees.
Right, as part of their compensation.
Exactly. And if you only look at the basic shares currently trading on the open market, you're getting an artificially rosy picture of the earnings.
Because it's ignoring all those unexercised options.
I got it. Diluted EPS assumes that every single one of those employee options has been cashed in, which expands the pool of shares. So when Costco reports 4.93 per diluted share, they're giving you the most conservative, battle-tested slice of the profit pie.
And that bottom line number represents a massive 15% jump year over year.
Which is wild. For a mature mega-cap company of Costco's sheer size to grow its bottom line by 15% in a single quarter.
It's highly anomalous, explosive, really. And moving to the top line, net sales hit $69.15 billion. That is an 11.6% increase from the same 12-week quarter last year.
$69 billion.
I mean, if Costco's quarterly revenue were a country's GDP, it would be a mid-sized global economy. But the number that really jumps off the page for anyone following retail economics is the comps.
Oh, absolutely. The comparable sales metric is basically the lifeblood of retail analysis.
Let me just break down comps real quick for anyone who might be newer to retail earnings reports. It stands for comparable sales, or same-store sales. It represents the revenue generated strictly by stores that have been open for over a year.
Right, ignoring the new builds.
Exactly. Because if a company wants to artificially inflate their overall revenue, they could just take out a massive loan and build 100 new stores. Total sales skyrocket, but it masks the fact that their existing stores might be bleeding customers.
Comps strip away all that shiny new store growth to show you the true underlying health of the footprint.
And Costco's worldwide comps were up an astonishing 9.8%.
What's fascinating here is what happens when you peel back the layers of that 9.8% figure. Because, that aggregate number is heavily influenced by two incredibly volatile external factors.
Gas and foreign exchange, right?
Yep. Gasoline sales and foreign exchange rate fluctuations. If global oil prices spike, Costco's total sales look artificially inflated because the price at the pump is higher, even if they aren't actually selling more physical gallons of gas.
Makes sense.
And similarly, foreign exchange or FX plays a huge role. Costco is a multinational corporation. If the US dollar strengthens significantly against the Canadian dollar, or say the Japanese yen, the revenue from those international warehouses translates back into fewer US dollars on the earnings report.
So it makes international growth look sluggish when it actually isn't.
Exactly. Analysts are always hunting for the core number to filter out that macro noise. They demand the core comps. And when management stripped out gas and FX entirely from this quarter, the core comps were still up a very healthy 6.6%.
That's incredibly strong. And on top of it, digitally enabled sales were up 21.5%. But, the crown jewel of this entire report, the number that basically dictates the survival of the business model, is the membership fee income.
The golden goose.
It grew to $1.373 billion, which is a 10.7% jump. Over $1.3 billion generated purely from people paying for the privilege to walk through the front doors.
And that money is essentially pure profit margin.
Right. But wait, I have a crucial plain language question here regarding the health of those sales.
Yeah.
Management noted on the call that the average transaction, the ticket size, went up 7.3% worldwide.
Okay.
Is that average ticket going up because people are actually pushing heavier carts to the register with more physical items in them? Or is inflation just making the exact same basket of everyday goods 7% more expensive?
That is the big question.
Because if it's just inflation, that isn't real growth. That's just, treading water in a rising tide.
This raises a really important point, and it was actually the primary focus of a Morgan Stanley analyst during the Q&A session. They demanded to know the composition of that 7.3% increase. Like, is it price, mix, or larger basket?
And what did management say?
The CFO, Gary Millerchip, provided a highly nuanced clarification. It's a combination, but the inflation component is behaving unexpectedly. People are indeed putting more physical units into their carts.
Okay, that's good.
But the real driver of the higher ticket size is a phenomenon known in retail as trading up.
Trading up, meaning the consumer is consciously choosing the premium version of a product over the standard version.
That is the exact mechanism. Gary Millerchip pointed out that while supply chain inflation definitely exists, a significant portion of that higher register receipt is members opting for better quality or higher value items.
Interesting.
This happens because the baseline pricing structure at Costco makes luxury or premium goods feel accessible to the middle class.
Oh, I see. So instead of buying the standard choice grade steak for a Tuesday night dinner, you buy the prime cut steak. Because the Costco price for the prime cut is roughly equivalent to what you'd pay for the inferior choice cut at your local neighborhood grocery store.
Exactly. You feel like you're getting away with something.
Though true.
And if we connect this to the bigger picture, traffic, meaning the actual volume of human beings scanning their cards and walking through the front doors, also increased by 2.4% worldwide.
Wow.
Think about the compounding effect of that math. You have a 2.4% increase in total humans entering the building. When they enter, they're putting more physical items in their cart, and the specific items they're choosing are higher quality, higher priced goods.
That trifecta is basically the absolute holy grail of retail metrics. The top and bottom lines look pristine on the spreadsheet, but to understand how they actually achieve this level of traffic in a macroeconomic environment where, let's be real, most consumers are actively pulling back on discretionary spend.
Right, everyone is tightening their belts.
We have to leave the massive warehouse aisles, walk out the front doors, and go out into the parking lot. Which brings us to the second pillar of our deep dive, the story behind the numbers. And the first chapter of this story is what I'm calling the gasoline magnet.
The gasoline operation is arguably the most misunderstood component of Costco's business by casual observers, but it is fundamental to decoding their Q3 results.
Tell me about it.
During the earnings call, CEO Ron Vakris made it abundantly clear right out of the gate. Against a backdrop of severe macroeconomic uncertainty and squeezed consumer wallets, their gas business was the undisputed star of the quarter.
Let's analyze the catalyst for this. During this quarter, we witnessed significant geopolitical volatility in the Middle East. That instability inevitably pushed global crude oil prices upward.
Yep.
Now, a traditional standalone gas station operates on a very specific psychological model. When wholesale oil prices rise, the local gas station views it as an opportunity to slowly creep their retail prices up.
Trying to pad their margins.
It's exactly. Attempting to pad their notoriously thin margins while blaming global events. What was Costco's strategic response to this oil spike?
Their response is basically the antithesis of traditional retail logic. Their primary directive is to keep the price per gallon as aggressively low as physically possible.
Wow.
And to ensure that, through rigorous supply chain management, their underground tanks never run dry. As oil prices climbed, Costco deliberately widened the price gap between their pumps and the local competitors.
So wait, let me make sure I'm following this. They saw their own costs going up, and instead of raising prices to match, they intentionally made their gas even cheaper relative to the guy down the street.
Yes. They understand behavioral economics. When oil prices spike and the evening news is running segments about expensive gas, consumer anxiety peaks.
Oh, totally. People freak out.
The average person becomes hypersensitive to the price per gallon. It becomes a daily stressor. Costco views this macroeconomic anxiety not as a chance to squeeze a few extra cents of margin out of the consumer, but as a prime opportunity to forcefully demonstrate their ultimate value proposition.
They absorb the pain to prove their loyalty to the member.
Exactly. And the financial result was staggering. Gas comparable sales were up in the high 20s.
High 20s. That is an absurd growth number for a commodity that people only buy when their tank is empty.
I know. They set successive all-time company volume sales records across all 3 4-week periods of the quarter. The final 5 weeks of the quarter were the highest volume weeks in the entire history of the corporation.
That's insane.
They were pumping an unprecedented ocean of fuel.
Let's translate this for the investor, because someone looking at a spreadsheet might be a little confused. Why does Wall Street care if Costco sells a record amount of heavily discounted gasoline? The profit margins on fuel are razor thin, right? Sometimes barely breaking even after the cost of the real estate and the attendance.
It's a massive logistical headache.
Right. So why does this matter?
What's fascinating here is the strategic deployment of the gas station as a customer acquisition cost. Gas acts as the ultimate physical trap.
The trap. Okay.
Because consumer price sensitivity reached a boiling point during this quarter, the widening price gap literally forced highly price-sensitive individuals, people who perhaps had a Costco card but rarely used it, to navigate to Costco gas stations for the very first time just to relieve their budget stress.
The behavioral shift makes perfect sense.
Yeah.
I mean, if you're agonizing over your weekly budget and you see that gas is 30, 40, or even 50 cents cheaper per gallon at the warehouse, you are finally going to dig that membership card out of your glove box and wait in that massive line at the pump.
And once that vehicle is in the parking lot, the trap is sprung. Management explicitly noted that members who utilize their gas stations possess a significantly higher lifetime value. They inevitably spend more inside the warehouse.
Because they're already there.
Exactly. The gas station is a funnel that drives foot traffic directly to the front doors. The consumer logic is undeniable. You're already navigating the chaotic parking lot. You just saved $5 to $10 on a single tank of gas. You feel a sense of financial victory.
So you might as well walk inside to buy a $5 rotisserie chicken. Or a bulk pack of paper towels.
Or perhaps a new television.
Right. It is a brilliantly engineered, closed-loop system. The gas savings justify the trip, and the trip generates the high-margin interior sales. Though an analyst from Bernstein actually probed this exact dynamic during the call.
They did.
Questioning if this massive traffic bump was merely a temporary sugar high caused by transient gas inflation. Like, would these customers vanish the moment global oil prices stabilized?
The CFO's response to that challenge was incredibly revealing. He conceded that while the acute pain of gas prices definitely catalyzed the initial visit for many dormant members, the behavioral loyalty it forged is highly persistent.
Oh, really?
Yeah. Their internal data proves that people who begin purchasing gas visit the warehouse more frequently over the course of a year. They spend a higher total dollar amount across all categories. And most importantly, they renew their annual memberships at a demonstrably higher rate.
Which brings us to the engine of the entire company, that renewal rate. It is currently sitting at an impenetrable 92.2% in the US and Canada.
It's unbelievable.
In the fickle world of retail, where consumer loyalty is usually bought and sold on a whim, retaining 92 out of 100 paying customers year after year is a structural anomaly.
It really proves that the membership fee is no longer viewed by the consumer as an expense. It's viewed as an investment that pays a guaranteed dividend in the form of savings.
So the parking lot is functioning perfectly as a giant gasoline-scented magnet. Now let's walk back inside the warehouse, because this brings us to the second operational pillar of the quarter. And frankly, this is my absolute favorite part of the earnings transcript. I call this financial judo and pricing power.
It's a great segment.
And to understand it, I need you to translate some dense accounting jargon for the audience. The CFO spent a considerable amount of time discussing a LIFO charge. Spell this out for us. What exactly is LIFO, and how did it impact the income statement this quarter?
LIFO is an acronym that stands for last in, first out. It's a highly specific accounting method used for valuing inventory, and it is entirely legal and strictly governed by corporate tax codes.
Okay.
To visualize it, imagine a literal stack of identical boxes in a warehouse. Under the LIFO accounting convention, you assume for tax and profitability purposes that the very last box you placed on top of the stack is the first box you take off the stack to sell to a customer.
Okay, that makes logical sense. It's the most accessible box. You don't dig to the bottom.
Exactly. Now apply this to an inflationary environment. Over the course of a year, the cost of manufacturing and shipping those boxes goes up. Therefore, that last box you bought, the one sitting on top of the stack, cost your company significantly more money to acquire than the boxes buried at the bottom of the stack, which you bought months ago.
Right.
By utilizing LIFO, you're legally matching your most recent, highest inventory costs against your current revenue. This mechanism lowers your reported gross profit on paper, which consequently reduces your corporate tax burden. However, it creates an accounting line item known as a LIFO charge on the income statement, representing that margin compression.
So to put it simply, it's a drag on a gross margin. It makes the company look slightly less profitable on paper.
Precisely. Let's look at the historical context here. Last year, in Q3, global supply chain inflation was raging across almost every commodity class. Costco was forced to take a massive $130 million LIFO charge.
Ouch.
It was a severe headwind to their profitability. But this year, the macroeconomic environment has shifted. Inflation has cooled considerably within their specific supply chain networks. Because the cost of acquiring that top box stabilized, the LIFO charge for this quarter plummeted from $130 million all the way down to a mere $44 million.
Here's where it gets really interesting. Think about how a traditional, publicly traded retailer would react to this scenario. A normal executive team would look at that massive drop in accounting expenses, an $86 million swing in their favor, and they would throw a party.
Oh, absolutely.
They would allow that $86 million in savings to drop directly to the bottom line. They'd report an artificially pumped up profit margin to Wall Street, the stock would pop, and the executive suite would quietly collect their performance bonuses.
But that is fundamentally contrary to Costco's operating philosophy.
This is the financial judo I'm talking about. In martial arts, judo is the practice of using your opponent's weight and momentum against them. In this scenario, inflation is the opponent crushing the retail sector. Competitors are struggling to maintain margins, but Costco took that $86 million accounting relief, and instead of hoarding it, they weaponized it.
Yep.
They had extra breathing room, so they immediately turned around and slashed retail prices on everyday items.
This aggressive maneuver was actually a major point of friction during the analyst Q&A. The Morgan Stanley analyst, poring over the spreadsheet, noticed that the core-on-core margin actually dropped by 9 basis points.
Let's define those terms quickly for the audience.
Sure. A basis point is simply 1/100th of 1%. It's how finance professionals measure tiny fluctuations in interest rates or margins, and core-on-core margin measures the pure underlying profitability of the actual merchandise being sold, stripping out all the noise of gas, membership fees, and currency swings.
Okay.
So the analyst saw this pure metric drop slightly and asked, essentially, are you intentionally sacrificing your own profit margin to steal market share from your competitors? And the CFO's answer was an unequivocal yes.
Incredible. They took that $86 million windfall and poured it directly into the consumer's wallet. They lowered the price on vital everyday essentials like eggs, beef, and fresh produce. And they got exceptionally aggressive with their in-house private label Kirkland Signature brand.
They really did.
They dropped the price of Kirkland crispy wings from $16.99 to $14.99. A massive box of Kirkland golf balls went from $32.99 down to $29.99. Kirkland king-size sheets dropped $10 from $89.99 to $79.99.
The CEO, Ron Vakris, chimed in during that specific line of questioning with a quote that I believe defines their entire corporate ethos better than any mission statement could.
What did he say?
He told the analysts, our goal is to be the first to lower prices and the last to raise them. He made it explicitly clear that these price cuts were not reactionary moves to clear out dead inventory. They were calculated strategic offensives.
Wow.
The moment Costco's massive purchasing power allows them to grab lower-priced inventory from suppliers, they immediately pass that exact dollar amount down to the price tag on the warehouse floor. They suffocate competitors who simply do not have the volume to match those price cuts.
It is a phenomenal psychological play. They are actively training the consumer to trust them unconditionally. When you walk into a typical grocery store, you have your guard up. You're constantly checking unit prices, looking for deceptive packaging, wondering you're getting gouged on the cereal aisle.
But when you walk into Costco, that cognitive load vanishes. You know you aren't getting gouged because you implicitly trust that the moment Costco saves $1 on the back end, they're giving you 90 cents of it on the front end.
If we connect this to the bigger picture, this pricing authority is exactly why Costco remains entirely immune to the standard retail headwinds that plague companies like, say, Target or Dollar General. Later in the call, an analyst from JP Morgan asked a very leading question about whether the broader retail market was acting rationally regarding pricing and impending global tariffs.
The analyst was totally fishing for Costco to complain about irrational competitors slashing prices.
Right. And Costco management basically shrugged off the premise. They essentially stated, "We don't care what the market is doing. We are our own toughest competitor. Our only mandate is maintaining absolute pricing authority over every item in the building."
It's such a flex.
It really is.
Oh.
Okay, so we've established the gasoline strategy, pulling millions of anxious consumers into the parking lot, and the financial judo creating unbeatable blind loyalty once they're inside the warehouse. But there is a massive macro trend sweeping the globe right now. It's altering consumer behavior at a fundamental biological level, and it showed up in a major way in this earnings transcript. Let's talk about the GLP-1 and AI tailwinds.
This segment of the call was truly fascinating because it intersects pharmaceutical innovation with grocery logistics. When we talk about GLP-1s, we're referring to the massive revolutionary wave of weight loss and diabetes medications.
Drugs like Ozempic, Wegovy, and Mounjaro. These drugs are fundamentally changing how millions of human beings consume calories. They work by mimicking hormones that signal satiety to the brain. They suppress appetite, they eliminate food noise, and they drastically alter cravings. And for the past 12 months, Wall Street has been in an absolute panic over this.
Oh, complete panic.
Analysts have been publishing apocalyptic reports suggesting that massive snack conglomerates and traditional grocery stores are going to see their revenues crushed because a significant percentage of the population simply isn't consuming high-margin junk food anymore.
That is the prevailing Wall Street narrative. But look at Costco's internal numbers. Their ancillary businesses division, which prominently features their in-house pharmacy, saw comparable sales up in the mid-20s.
Mid-20s growth for a pharmacy is staggering.
The CFO explicitly stated to the analysts that the pharmacy led the entire division and captured significant market share, driven heavily by the inclusion of Wegovy and Ozempic in their member prescription program.
So on one hand, they're capturing a massive new revenue stream simply by dispensing these blockbuster drugs. They have the foot traffic, so people transfer their prescriptions to the warehouse. But I have to push back on the broader implications here.
Sure.
What about the food side of the warehouse? If millions of Costco members are taking drugs that make them eat 30% less food, and they are specifically avoiding the highly processed, high-margin snacks that take up half the warehouse, isn't that ultimately a catastrophic headwind for a grocery business built on selling bulk volumes of calories?
I completely see why you would draw that conclusion, and an analyst from Baird asked exactly this question during the call. How are these GLP-1 medications influencing category performance across the food aisles?
And what was the answer?
The management team's answer demonstrated why their merchandising team is considered the best in the world. They aren't sitting around paralyzed watching their junk food sales decline. Because they possess closed-loop data on 82 million members, they noticed the dietary shift in the purchasing data immediately, and they executed a massive, rapid pivot into protein.
Protein is the critical nutritional component for anyone on a GLP-1 drug. Because the medication causes rapid weight loss, patients must consume incredibly high amounts of protein to ensure they were losing fat, not lean muscle mass.
Exactly. The CFO noted explosive, sustained growth in protein snacks, protein bars, and premium beef sticks. They even fast-tracked the launch of a brand new Kirkland Signature beef stick to capture this specific demand.
Wow.
And it is doing tremendous volume. But CEO Ron Vakris added a piece of anecdotal intelligence that is even more revealing. He stated that he has been holding intensive meetings with the massive consumer packaged goods companies.
The CPGs. The ones who manufacture the world's food supply.
Right. Those manufacturers are panicking and pivoting their formulations rapidly. To capitalize on this, Costco just launched a new Kirkland Signature ultra-filtered milk in the dairy section. It's specifically formulated to be high in protein, high in fiber, and high in magnesium.
Which are the exact macronutrients required by GLP-1 users.
Precisely. And it's flying off the shelves.
That level of agility is breathtaking. They see the macro trend emerging in the culture, they capture the initial pharmacy traffic to get the patient in the door, and while the patient is waiting for their prescription to be filled, Costco has already remixed their grocery aisles to sell the exact high-margin complementary nutritional products that this newly altered consumer requires. That is executing at the highest possible level.
And they are applying that same ruthless execution to their technology infrastructure, which, if we are being honest, has historically been a glaring weak spot for Costco.
I will be more than honest. For the last decade, Costco's app and e-commerce website felt like they were coded in 2005. The search function was clunky, the interface was archaic, and the delivery options were convoluted. It felt like they actively wanted to discourage you from shopping online because they desperately needed you inside the physical warehouse to trigger impulse buys.
That assessment was entirely fair a few years ago, but the transcript proves they are aggressively remediating that technical debt. E-commerce same-day delivery in the United States, which is powered by third-party logistics partners like Instacart, is now averaging delivery times of under 45 minutes from the moment the order is placed.
That's fast.
Furthermore, the internal member satisfaction rating on those deliveries is sitting at a 4.8 out of 5. That specific segment is growing faster than their overall digital business.
Okay, I have to stop you there because that feels like a massive strategic vulnerability. Under 45 minutes for Costco-sized items is impressive, yes. But by outsourcing the actual delivery to a third-party gig economy platform like Instacart, Costco is essentially renting the customer relationship at the most critical touch point.
The front door.
It's exactly the front door. If Instacart decides to hike their API fees, or if their driver quality drops and ruins the customer experience, Costco is trapped. Walmart built their own proprietary delivery fleet. Amazon obviously owns their logistics network end-to-end. I cannot understand how Costco management is not terrified that they don't own their own last-mile logistics. And analysts from Truist actually pressed them on this, didn't they? Asking if Costco needs to build out their own infrastructure.
They did press them on it. And while your concern about owning the customer relationship is valid in traditional tech sector analysis, you have to look at Costco's capital structure.
Oh, so?
The CEO's response essentially boiled down to, why on earth would we deploy billions of dollars of our own capital to buy a fleet of refrigerated trucks when our partners are successfully executing the mission in under 45 minutes with near-perfect customer ratings?
I mean, when you put it that way.
Costco is obsessed with return on invested capital. Building a proprietary logistics network from scratch is a massive low-margin capital sink. Right now, the capital-light approach of leveraging existing third-party networks is working flawlessly for the member. They will evaluate building their own network if the unit economics dictate it, but currently it would be a waste of shareholder money.
Okay, I will concede the math on the capital allocation. Letting Instacart burn their own venture capital to deliver bulk toilet paper does protect Costco's balance sheet. But the technology upgrade they discussed wasn't strictly limited to delivery logistics. They spent significant time discussing artificial intelligence. And I usually despise using AI as a buzzword in earnings podcasts because usually it's just an executive trying to artificially inflate their stock price.
Sure.
But the data they presented here is highly compelling.
The implementation is very real and highly lucrative. E-commerce site and app traffic was up 37% in the quarter. They recently launched personalized AI-driven product recommendation carousels,
which are essentially machine learning models predicting exactly what a member is likely to buy next based on their historical scan data.
Exactly. Those carousels generated conversion rates 3 times higher than their legacy rules-based recommendations. That single technical upgrade drove $500 million in incremental e-commerce sales.
$500 million of newly discovered revenue just by showing the customer a slightly more accurate picture of a kayak or a laptop. That's wild. But the piece of the AI discussion that blew my mind was when the CFO detailed the impact of generative AI searches.
This is huge.
Meaning consumers using large language models like ChatGPT or Perplexity to search for products across the internet, rather than using a traditional Google keyword search.
This is a crucial evolution in consumer behavior, and it uniquely benefits Costco. Because historically, Costco's true value proposition is often hidden from a rudimentary internet search. The CEO provided a perfect illustrative example regarding major appliances. If a consumer uses a standard keyword search engine to look for a specific Samsung refrigerator, the search engine crawls the web and pulls the base retail price from various retailers. Home Depot might show $1,000. Costco might show $1,050.
So to the keyword search engine, Costco looks more expensive.
Exactly. But the reality is that Costco's $1,050 price tag implicitly includes the cost of delivery, the cost of complex installation, the cost of hauling away the old broken refrigerator, and an extended warranty. Regular search engines are not sophisticated enough to capture that bundled value.
Oh, that is absolutely brilliant. A traditional search engine just scrapes the bold font number.
Yeah.
But these new generative AI models are designed to comprehend context. They can read the fine print.
Yeah.
So when an AI acts as a shopping assistant and compares prices across the internet for a consumer, it synthesizes all those variables and realizes Costco is actually offering the vastly superior economic deal because it factors in all the hidden freebies that Home Depot charges extra for.
The same logic applies to their automotive tire business. Costco's price includes installation, lifetime balancing, road hazard warranties, and nitrogen inflation. The AI sees the total cost of ownership, not just the rubber.
Wow.
The CFO noted that while the overall volume of traffic originating for these AI search engines is still a relatively small percentage of their total traffic, it experienced triple-digit growth in Q3. More importantly, that specific cohort of AI-referred traffic boasted the highest conversion rate of any traffic source coming to their site. The AI is doing the complex math and explicitly telling the consumer, buy this at Costco, it is objectively the best deal.
So let's summarize their current operational posture. They are ruthlessly executing in the present by exploiting massive macroeconomic trends. They're using Middle East gas volatility to trap new customers in the parking lot. They're using accounting maneuvers to lower prices and suffocate competitors. They're capitalizing on the GLP-1 health shift by rapidly overhauling their supply chain to prioritize protein. And they're letting AI algorithms uncover their hidden value proposition to the broader internet.
They're leaving absolutely nothing on the table.
Which brings us perfectly to the next phase of our deep dive. Management guidance. We know the historical data, we understand the present strategy, but where is this massive executive team steering the ship next? Let's analyze their capital expenditures, commonly known as CapEx.
Costco management announced they are planning to spend approximately $6.5 billion in capital expenditures this fiscal year alone.
$6.5 billion. I mean, even for a company of this scale, that is a staggering amount of cash to reinvest in a single year. Where exactly is that capital being deployed?
The overwhelming primary focus of that $6.5 billion is physical footprint expansion. They are targeting a run rate of 30-plus net new warehouse openings per year globally in the coming years.
Okay.
For this specific fiscal year, FY26, they did revise that number slightly downward to 26 net new openings, primarily due to localized permitting and construction delays that pushed two specific buildings into the FY27 timeline. But the overall development pipeline remains incredibly robust.
An analyst from Guggenheim pressed them pretty hard on this pipeline during the call, specifically regarding international expansion. And, I mean, it's a valid concern. The United States market has to be approaching saturation. There are only so many suburban American intersections that can support a 150,000 square foot warehouse. Where is the remaining geographical white space for a company this size?
The CEO painted a highly aggressive, multi-continent international roadmap. He noted that they still see consistent, strong runway for growth in Canada over the next 5 years. However, the true exponential white space lies in Europe and Asia.
Asia makes sense.
Yeah, he highlighted massive untapped opportunities remaining in China, South Korea, and Japan markets, where the rising middle class is rapidly adopting the bulk purchasing model. In Europe, their footprint is still relatively young in France, but they expect significant accelerated growth in Spain over the next 3 years. And the United Kingdom division has been exhibiting incredibly strong unit economics.
So the global footprint is just going to keep expanding relentlessly. But there is a completely new, fundamentally different revenue stream they casually announced deep in this call that completely blew me away. It represents a paradigm shift for the company. Let's talk about the advertising pivot.
This is a massive structural evolution for Costco. Management highlighted a brand new strategic collaboration with Google Commerce Media and YouTube.
Stop right there and translate this for the retail investor listening to this in their car. What does a bare-bones concrete warehouse selling bulk hot dogs and discount tires have to do with Google search algorithms and YouTube digital video ads?
Well, Costco is utilizing this partnership to build what is known in the advertising industry as a retail media network, or an RMN. To understand why this is so lucrative, you have to look at the data they possess. Costco currently has 82.9 million paid, highly engaged members. And because the fundamental rule of the warehouse is that you must scan your physical or digital membership card at the register before you can purchase a single item, Costco possesses a flawless, unbroken ledger of your purchasing history.
Oh, wow.
They know exactly what you buy, the precise time and date you buy it, the frequency of your replenishment cycle, and the exact physical location of the transaction. In a digital advertising landscape that has been severely blinded by Apple's recent privacy updates and the death of third-party tracking cookies, Costco's first-party closed-loop data is some of the most pristine, high-fidelity consumer intelligence on the planet.
Right. Let's make this tangible.
Yeah.
They don't just possess a vague demographic profile that says this user probably likes snacks. They possess hard, undeniable data that I specifically purchase a 3-pound bag of Kirkland Signature sea salt popcorn every 3 weeks on a Saturday morning.
Exactly. And consumer packaged goods brands, the massive conglomerates manufacturing that popcorn, the soda, the televisions, the detergent, they are absolutely desperate for that level of deterministic data. It solves the biggest problem in advertising attribution.
Proving that an ad actually led to a sale.
Precisely. So, Costco is going to start charging these consumer brands massive premiums for the ability to run targeted advertising on Costco's digital platforms, their mobile app, and potentially offsite across the Google and YouTube ecosystem using Costco's data to target the ads.
This is them finally waking up and executing the Amazon playbook, isn't it? Amazon makes a staggering, almost incomprehensible amount of money, not from selling you a phone charger, but by charging 3 different electronics companies for the right to appear as a sponsored product at the very top of your search results when you type in the word charger.
Yes, it is the exact same high-margin playbook, and the margin profile is what makes this so revolutionary for a grocery retailer. Selling a massive 30-roll pack of paper towels yields a very low single-digit profit margin because you have to source the pulp, manufacture the paper, wrap it in plastic, put it on a diesel truck, store it in a massive warehouse, and pay an employee to ring it up.
Friction is immense.
Selling a digital ad placement, a few pixels on a smartphone screen, has a gross margin bordering on 80 to 90%. It is virtually pure profit.
That margin profile is game-changing for their bottom line. But wait, an analyst from TD Cowen asked a highly perceptive question regarding the cultural risk of this pivot. The entire psychological vibe of Costco is simplicity and trust. You go there because they don't have 80 different brands of ketchup screaming for your attention. They just have 2 highly curated options. Doesn't plastering digital ads and sponsored placements everywhere ruin the pure, curated member experience that built the company in the first place?
That is the exact tightrope the executive team has to walk, and it is fraught with risk. The CFO was adamant during his response that the member experience remains the unquestioned priority. He stated that the goal of the retail media network is not simply to spam members with generic, intrusive banner ads.
Good.
The goal is to build sophisticated personalization capabilities that deliver highly relevant messaging. If the algorithm knows you faithfully buy a 40-pound bag of premium dog food every month, it might serve you a highly targeted ad for a new Kirkland Signature orthotic dog bed. It feels like a service, not spam.
That makes sense.
And crucial to the Costco model, he promised that 80 to 90% of the immense financial value generated by this high-margin advertising business will not be hoarded by the executives. It will be reinvested right back into the core business to subsidize even lower prices on physical goods for the member.
It all feeds back into the central flywheel. They use the ad revenue to make the rotisserie chicken cheaper, which drives more traffic, which generates more data, which allows them to charge more for the ads. It is a beautiful, self-sustaining loop. Okay, let's hit the final, highly anticipated piece of the forward guidance, and this is a massive topic for anyone holding the stock: the cash hoard.
Costco is currently sitting on an absolute mountain of liquid cash. An analyst from Gordon Haskett ran the balance sheet numbers and pointed out to management that they're holding roughly $45 in cash per share.
$45 per share.
Yeah, that is billions of dollars sitting idle. And he essentially asked the question every institutional investor is thinking: what exactly are you going to do with all that money?
In a high interest rate environment, having cash isn't terrible. But investors ultimately want that capital put to work. Are they signaling a massive acquisition? Are they going to buy a smaller regional competitor? Or are they going to initiate massive stock buybacks to pump the share price?
What's fascinating here is their incredibly disciplined, almost stoic approach to capital allocation theory. The CFO immediately reiterated that their unquestioned number one priority is organic reinvestment in the business.
Right.
That means funding the new international warehouses, upgrading the logistics depots, financing the AI technology rollouts, and even deploying capital to expand their own internal hot dog manufacturing capacity.
Which is an amazing tangent all on its own. The fact that they literally had to build and operate their own massive meat processing plants just to maintain the absolute 1.5 deal price point of the hot dog combo against decades of inflation.
It's a testament to their brand discipline. But even after fully funding all of that aggressive internal reinvestment, they are still generating massive amounts of excess free cash flow. They have a choice on how to return that excess cash to the shareholders. Historically, they slowly grow the regular quarterly dividend over time, and they execute just enough stock buybacks to offset the dilution created by employee stock grants. But they refuse to engage in the massive multi-billion-dollar stock buyback programs that companies like Apple or Meta use to financialize their stock price.
I need you to explain the rationale behind that. If the underlying business is performing this flawlessly, shouldn't the management team want to buy up their own stock? Shrinking the pool of available shares automatically makes every remaining share more valuable. It artificially inflates the EPS. Why avoid that tool?
Because Costco stock is historically priced at a massive premium valuation. The price-to-earnings ratio is often stratospheric compared to traditional retailers. The management team looks at that valuation through the lens of strict capital efficiency and says, why would we authorize the purchase of our own stock when it is trading at an all-time high?
Oh, I see.
Buying at the absolute top of the market is not the most efficient use of shareholder capital. So instead, the CFO utilized this earnings call to essentially tee up a future special dividend.
Let's clearly explain the mechanics of a special dividend for the newer investors who might only be familiar with standard quarterly yields.
Normally, a mature company pays a set, predictable dividend every 3 months, say $1 per share. It provides a steady yield. A special dividend is a massive, highly unusual one-time cash payout.
A windfall.
Exactly. Costco has executed this maneuver several times throughout their corporate history. When the cash hoard gets too large, they simply take a huge chunk of it, sometimes $10 or $15 per share, and drop it straight into the brokerage accounts of the shareholders of record.
That's amazing.
The CFO explicitly noted during the call that at their current historically high stock valuation, a special cash payout is mathematically the most effective way to return immense value to the owners without sacrificing the balance sheet flexibility required to keep opening new warehouses.
Now, to be clear, he did not announce a specific date or dollar amount on this call, correct?
No, there was no concrete timeline provided. He simply noted that their cash balances continue to compound rapidly, and they will continually evaluate the timing of a payout with the board of directors. But for anyone currently holding the stock or considering opening a position, it is a massive, multi-billion-dollar carrot dangling in the near future.
Okay, let's pull all of these threads together. We have analyzed the historical numbers, which are functionally flawless. We have dissected the present strategy, which relies on ruthless execution, leveraging gas volatility, deploying accounting judo to slash prices, and pivoting the supply chain to meet pharmaceutical health trends. And we have outlined the future guidance, which promises massive international expansion, a high-margin digital advertising ecosystem, and a looming special dividend. It is time for the final verdict.
The verdict derived from this transcript is incredibly straightforward.
Unapologetically bullish.
Unapologetically.
So what does this all mean for the retail investor listening right now? If you are holding Cost Station in your portfolio, or you are staring at the ticker symbol wondering if the valuation is too rich and you've missed the boat, what is the ultimate actionable takeaway from this hour of analysis?
The actionable takeaway is that this Q3 earnings transcript proves, beyond any shadow of an analytical doubt, that Costco possesses an impenetrable, multi-layered economic moat. They have engineered a business model that is entirely insulated against the standard macroeconomic headwinds that destroy traditional retail portfolios.
Right.
Consider the scenarios. If global inflation spikes and gas prices go through the roof, their physical warehouse traffic actually goes up because anxious consumers are desperate for financial relief at the pump, which inevitably pulls them into the high-margin store.
It functions as a literal hedge against inflation within an equity portfolio.
Exactly. If consumer diets drastically and permanently change overnight because of revolutionary pharmaceutical interventions like GLP-1 drugs, Costco doesn't suffer. Their internal pharmacy booms from dispensing the medication, and their merchandising team is so agile and data-driven that they instantly pivot the grocery mix away from declining junk food and into high-margin, ultra-filtered protein products.
It's bulletproof.
And if the broader economy slows down into a recession, their membership renewal rate sits like an immovable rock at 92.2% because the psychological certainty of the membership pays for itself in gas and grocery savings within a matter of weeks.
And meanwhile, while weathering all of these hypothetical macroeconomic storms, they are casually sitting on $45 a share in liquid cash, quietly preparing to shower their long-term investors with a massive special dividend. It is a corporate machine that is mathematically engineered to win in every possible economic environment.
It really is a masterclass in operations. The sheer institutional discipline required to take an $86 million LIFO accounting benefit and immediately drop the retail price of Kirkland chicken wings and golf balls instead of padding their own quarterly margins to please short-term analysts, that is the exact kind of long-term structural thinking that builds multi-generational wealth for shareholders.
It is the exact opposite of short-term reactionary Wall Street thinking. And ironically, that absolute defiance is exactly why Wall Street loves them and assigns them such a premium valuation.
Yeah.
But before we sign off, I want to leave you, the listener, with a final, highly provocative thought to mull over. It's something that builds on everything we just discussed regarding the future of this company. We spent a lot of time breaking down their new partnership with Google and YouTube. Think about the gravity of that data set.
It's massive.
Costco now possesses the exact, hyper-specific, unbroken purchasing history of 82.9 million paid verified members. They know exactly what you eat, what brand of clothing you wear, what specific tires you require for your vehicle, and what prescription medications you take to manage your health.
It is an ocean of pristine, closed-loop, first-party data. In the modern digital economy, that data is infinitely more valuable than the physical goods sitting on the pallets.
Right. And if management can successfully monetize that data through this newly announced retail media network, if they can truly begin charging digital advertising rates with 80 and 90% profit margins to the biggest consumer brands on earth, and if they can execute this maneuver without ruining the pristine treasure hunt warehouse shopping experience that generates the loyalty in the first place, it forces a reevaluation of the entire company. Is Costco really still just a physical retailer? Or are they quietly, right in front of our eyes, transforming into a high-margin data and media conglomerate that merely uses a bulk grocery store as a physical mechanism to harvest the data?
That is the multi-billion-dollar question that will define the next decade of their stock performance. If they successfully crack the code on retail media without alienating the core member, the terminal valuation ceiling for this company is much, much higher than any traditional retail analyst is currently modeling.
It is certainly something to think about the next time you're standing in line, scanning your card for a $1.50 hot dog. You aren't just buying lunch, you're feeding the algorithm.
Thank you all for tuning in to the Special Talk Tickers Deep Dive. As always, don't just take our word for it. Keep questioning the numbers, keep digging into the raw transcripts, and keep learning. We will see you on the next Deep Dive.